Many thanks, Samo. Many thanks, John. Now let's move to the last paper of this session. Is a paper. One of the authors is actually John, but will be one of the co-authors to present paper entitled "Monetary Transmission Through Bank Securities Portfolios." It's a very good example again of the use of very granular supervisory data, and very topical, the transmission of monetary policy during monetary tightening cycles. So, Daniel from New York Stern School of Business will present the paper. Many thanks, and Daniel, the floor is yours.
Okay, thank you so much. Hopefully everyone can hear me. So thank you so much for putting us on the program. This is joint work with John, who you just saw, as well as Pascal, and there's some Fed involvement, so the usual Fed disclaimer applies. So the motivation for this paper, like a lot of banking research these days, you can kind of bring back to SVB. So we kind of know what happened there. They had invested in a bunch of long-term securities, which were booked as held to maturity. And when these securities fell in value, investors basically ran on the bank and led to kind of what we all saw, right? So there was some policy interest in thinking about, well, HTM, maybe one of the issues is that it's not mark to market. So a recent Chicago Booth survey asked a bunch of experts, for the purposes of capital regulation, should banks be required to mark their holdings of securities to market at all times, even though their loans are not marked to market? And you can see there's actually quite a bit of dispersion in the answers. But actually, a lot of people agree, right? And for one kind of prominent example, Darrell Duffy makes the point that actually, basically, if SVB had been marking its securities to market, its capital position would have been deteriorating with the losses. They would have had to recapitalize. We might have avoided the run. But Cam Harvey actually makes a very interesting point that, you're marking to market the securities, but you're not actually doing anything to the liabilities. So if a bank is actually well hedged and it's kind of matched up its assets and liabilities well, you're going to be catching one side of that and not the other. And the result could be that even for well hedged banks, you start putting additional pressure on their balance sheets when the value of securities moves by marking to market, and that could cause an issue. So we're not gonna take a stand on who's right here. There's a lot of sides to this, a lot of factors to consider, but we are gonna focus a lot on this mechanism that Cam brings up. So the question that we're gonna ask in the paper is, how do policies marking securities to market when computing capital requirements influence monetary transmission from interest rates into bank lending? The approach that we're gonna take is to combine some institutional bank data with a structural model to interpret it. On the data side, we're going to use the Y14 stress test data, which is super detailed data on securities, associated hedges, and the near universe of C&I lending at all sufficiently large U.S. banks. Now, in order to capture what's going on with the capital requirement channel, the regulatory capital channel compared to other things that we know that changes in security values can do, we're going to exploit for identification the fact that different banks actually have their AFS securities treated differently, as well as the fact that you can actually put your securities in different buckets that have different mark-to-market treatment. So we're going to be kind of trying to exploit this to get our identification. Last, we're going to basically match up our results to calibrate a structural model that's designed to kind of take our cross-sectional results to GE, and we're going to be able to take a look at how this mechanism, this channel whereby our regulatory capital is getting marked to market over time, is going to influence the overall transmission of interest rates or monetary policy to the broader economy. So what do we find? First, we find that changes in securities values really do impact bank lending to firms. Basically, when security values fall, banks actually lend less to their customers. But that this mainly occurs when the change in security values are of a type that affects mark-to-market regulatory capital calculations. Basically, if it doesn't sort of get passed through into the calculation of regulatory capital, it seems to have a much smaller or potentially zero effect. Okay, so it really seems that the dominant force, according to our estimates, is this regulatory capital effect. We also find that these credit supply changes at the bank level pass through to investment at small firms, but not to large firms. And finally, I'll show you in the model that all this basically means that this is a force amplifying the transmission of interest rates and monetary policy. So I'm going to skip the lit review. There's a lot of amazing research. We've seen some of it today, and just jump into the institutional setting. So how does all this stuff work with the balance sheet and capital? So in this kind of left side here, you have the balance sheet of a typical bank large enough to have some of its securities marked to market. And so on the asset side, you have the loan book, of course, and then you have the securities. I'm assuming for this example that these are all available for sale, okay? Now, on the right-hand side, you have the bank's capital, and this has two pieces. So it has some debt, which is probably mostly deposits on the bottom. But then if you look at the top right-hand side, it has its capital, right? And that comes in two pieces. There's kind of what you could think of as the book capital, the capital they raise themselves. Here it's called capital NC for a reason I'll explain in a second. And then you have this stuff called AOCI, right, which stands for Accumulated Other Comprehensive Income. You can think of it roughly speaking as gains and losses on these mark-to-market securities, right? And because for this bank they're marked to market, they actually enter the total capital calculation. So the total capital computed by the regulator would be this capital NC term plus this AOCI term, which will form the capital AC. Okay. Now, what might happen when the value of securities falls? When, in this case, on the asset side, the box corresponding to the AFS security is going to shrink because the securities are less valuable. And that's going to actually decrease the AOCI. So this was a bank who had experienced some gains in the past. What I'm showing you here is what if those gains are totally wiped out, right? And you can see that the effect here is that it's actually going to shrink the box of the total capital computed by the regulator, right? This capital AC. So the debt is going to be the same, but the capital shrinking, that's going to tighten capital requirements. And as a result, this bank may face some regulatory pressure to either raise capital or alternatively, because we know banks don't like raising capital, to cut lending somewhere to reduce the size of their asset or loan book, their risk-weighted assets, okay? So what are the wrinkles here? First, I assume this was a bank big enough to pass what's called the AC filter, right? Meaning this is actually done. For banks that are smaller, we're going to call those AC banks. For banks that are smaller, which we'll call NC banks, they don't have AOCI counted toward their capital. Their AFS securities are effectively not marked to market by the regulator, and their balance sheet, both before and after the change, would look like this balance sheet on the right-hand side, okay? So it's only going to be some banks. Last, I'm going to note there are a bunch of things going on at the same time. It would be very hard to look at what this bank does in isolation and conclude what's coming from the fact that their securities were marked to market. So why? Because when the value of securities falls, first, the bank actually lost money, right? There's a net worth effect. Second, as we just talked about, banks like to use these securities as collateral, maybe for repo deals or some other deals. The collateral value fell. And only in the third channel, right, as one component of this mixture is the regulatory capital channel. So we're going to have to think about this going forward. Now, what we're going to basically use to do that is the fact that there are other types of changes in securities values that won't have this effect. First, like I said, NC banks will not be affected by this. Second, hedged securities will not be affected by this. Why? So if you've hedged your AFS securities and the value of securities falls, yes, so you can see here this box shrinks for your AFS securities, but that's exactly offset by this new box showing up, which is that the value of your hedge increases, right? That totally counts to the regulator, and as a result, your capital is basically insured. You're going to have no change in the measured value of your regulatory capital. You could have some other effects because in general, hedges are less pledgeable than the securities. You could have collateral effects, but it's going to remove kind of the net worth and regulatory effects. And finally, for HTM securities, right, to the regulator, they're not going to see anything happening because these will not be marked to market, right? And so in this case, you're going to get the net worth effects and potentially the collateral effects, but not the regulatory effects. So we have a lot of different variation. Only a subset of it affects the regulatory capital channel, and that's what we're going to exploit in our empirics. Okay, so I know that was a bit quick, but these are kind of experts in the room, so I hope it was clear enough. For the data, we're going to use the Y14 data. It's a very detailed data set for banks sufficiently large to be subject to stress tests. There's only like a couple dozen of them, but they're very big. So they cover about, for example, half the US C&I lending market. And we're going to combine quarterly data from three schedules. First, we're going to have securities. So we're going to have a detailed panel on the security portfolios held by the banks. Second, very important, we're going to see the designated accounting hedges matched to the securities, right? So we're going to be able to see, exactly what they're hedging and what they're not, without which this would be very difficult, right, to do. And last, we're going to have a corporate loan panel on basically all the loan facilities over $1 million that these banks have issued to firms, right? So it's going to be a very detailed data that's going to cover a lot of firms. So in addition to like the public firms you'd normally get in CompuStat or maybe DealScan, we're going to have about 200,000 private firms as well. We're going to augment this with Y9C data to get some bank characteristics, as well as CompuStat data to get some public firm characteristics, although the data actually provides a lot of firm financials for the private firms. And we're going to focus on the period 2021 to 2023. Over the second half of this period, you have this big rise in interest rates, big drop in the value of fixed income securities, and we have the first half of that as kind of a pre-sample. Over this period, there are about 30 banks in the sample. 1/3 of these are AC banks, right? So only a subset of even the banks in our sample actually have their AFS securities marked to market by the regulator. We call those AC banks. That's 1/3 by number, but remember, they're bigger. So this actually ends up being about a 50-50 split in terms of CNI lending. All right, so let's first go into some stylized facts, then I'll show you our detailed results. So first, what are these banks holding as securities? So here's the breakdown. You can see, first of all, the basic, one sentence answer is it's all risk-free fixed income stuff, right, more or less. It's mostly agency MBS. The rest is mostly treasuries. And then you have some munis and other things. But, this is a portfolio where the main risk is coming from interest rate risk, not from credit risk or something like this. In terms of hedging, you can see that 90% of it is unhedged, basically. You have about half of it that's in the AFS category, unhedged, plus 11%. So 60% total is in AFS, of which kind of this minority is hedged, and about 40% is in HTM. So here's kind of some interesting time series patterns. These are not core to our results, but I think they're so cool, I'm going to show you them quickly anyway, which splits basically how these portfolios are evolving by AC banks whose AFS securities are marked to market and NC banks who are never marked to market on their securities by the regulator. Okay, and what you can see is during this COVID period, the NC banks are taking both types increase their securities, but the NC banks are taking this enormous securities position relative to their assets, which is making them in some sense more exposed to value changes. But the AC banks are much more cautious, perhaps because they're aware that taking on such a big position will expose them to more regulatory risk in the future compared to the NC banks. Similarly, the AC banks end up putting a much higher fraction of their securities in HTM, which are not marked to market, and into hedged AFS, right? They're doing much more hedging. So you can see that over all these things, this is not the core result of our paper, but the AC banks really seem to care about the fact that they're marked to market, and they're taking a lot of actions to kind of keep their portfolios from being too exposed to this regulatory risk. Okay, so now with all that lead up, let me show you our main results on credit supply effects, right? So when bank securities lose value, are lenders cutting credit to firms, right? As usual, you don't want to just get your effects driven by the fact that a certain type of bank links with a certain type of firm, and then you have unobservables driving everything. So we're going to take the typical approach of following the Quajan-Mian, and we're going to estimate a regression where we have 2-quarter growth in lending from firm I to firm I from bank J. This thing with this kind of funny looking ratio, this is just a centered growth rate. It's just like a growth rate, but it's really good at dealing with zeros or small values in the denominator. Then we're going to have a firm time fixed effect. That's going to deal with this kind of selection issue. So we're going to kind of take firm demand as fixed. We're going to have a bank fixed effect. So we're going to be looking within the firm at like multiple lending relationships. We're going to have a bank fixed effect, and then we're going to have a fixed effect for if you're an AC bank at a given time, because these AC banks are bigger, they might have a different business model, they might be doing something different. We're going to control for whether you're AC at a given time. Then we're going to have our coefficient of interest on the change in the value of your AFS securities as a fraction of your assets as a bank, plus some bank controls. Okay, and we're going to look at the impact on term loans only, because that's really the margin that the bank controls compared to credit lines. All right. So what do we find? Basically, in all of our specifications, we're going to do everything twice to either do firm time or firm time by loan purpose fixed effects, because that's kind of a critique that's been brought up with Quajan-Mian. Regardless, what we find in both cases, whether or not we include the HTM, is that when the value of securities goes up, banks lend more to firms. If you just flip the sign, that means when the value of securities fall, they're going to lend less to firms. In terms of magnitude, this is about 20 cents per dollar, and it's very significant. We can easily reject zero. In contrast, right, when you look at the change in the value of HTM securities that are never marked to market, we find small and insignificant effects, right? So what this means basically is that when the securities are potentially marked to market by the regulator, there's a lot of pass-through. When they're not, there's very little pass-through, right? And this would, for example, be consistent with the world where banks are very well economically hedged. They've matched up really well the duration of their assets and liabilities. But when their securities are marked to market by the regulator, they start having to make adjustments to meet their regulatory capital ratios. Okay. So that's kind of our main result, although we'll redo it a bunch of times, right? In the paper, we have tons and tons of different robustness checks on this. I'm not going to go through them, but you can see the paper if you're interested. And let me just show you two more for today. So first, we're going to have a different version where we're going to interact the AFS security value change by whether you're an AC bank. Because remember, actually, even at the NC banks, changes in AFS security values should not affect mark-to-market capital, right? And second, we're going to just basically differentiate between unhedged and hedged securities. All right. So let me show you the first one first. This is maybe our most important table of the paper. So what you can see here is that right now the first two columns are basically the exact regression I showed you before, but with this interaction term, with being an AC bank, meaning that the regulator will mark to market your AFS. And what you can see is now the base coefficient is not zero, it's smaller, but that the coefficient on the interaction, so this would be like the baseline for an NC bank. Being an AC bank, the additional change in your lending coming from the same change in value of your AFS securities is about twice as large as the original effect, meaning that the overall effect for AC banks is about 3 times as large, right? So you can see again that the vast majority of the effect is coming through the channel, the exact banks and security type where it's mark to market. But actually, that's not everything because, you know, these banks are different sizes. They have different characteristics. They're not balanced, right? And they might just have different business models in general. So what we're going to do in the last two columns over here on the right is we're going to take our bank controls and interact them with the change in AFS value. And that means that banks are now allowed in these last columns to have different reactions to changes in the value of AFS securities based on their characteristics, right? And we're going to control for that. And so now what we're going to be picking up is basically just whether you're above or below this AC filter after controlling for all the systematic differences in reaction you have just from the characteristics being different. And what you can see is now, actually, the point estimate for being an NC bank after we control for all this stuff is 0, right? Whereas the interaction term now contains the entire effect, which is, you know, about as large as the sum of the two columns here anyway, right? So once we control for that banks have different business models based on their different characteristics, we find that nothing is coming through the base change in the value of the AFS. Everything's coming through being a type of bank, having changed the value of AFS, and being a type of bank that has its AFS securities marked to market by the regulator. So again, this is strong support for the regulatory capital channel being really important, and for little effect of the change in security value outside this channel, right? So again, with this and the HTM both, you have all the change in the net worth is the same, the actual impact on bank net worth is the same, but the regulatory capital channel seems to be driving a lot. So I'm going to go through this very quickly. We see the same thing for hedging, right? If your securities are hedged, they now don't affect your regulatory capital. Again, we get much bigger and more, significant effects for when the securities are unhedged, and smaller and insignificant effects when the securities are hedged. So again, it seems to mainly come through when it mark-to-market affects your regulatory capital. All right, so now we have a bunch of other different robustness checks I'm not going to show you. The most important one is probably that we do interact this with bank capital positions. We find that banks with a bigger capital buffer are reacting less on this margin. So it's the banks who are closer to the capital requirement binding who are reacting more in terms of their cuts to firm lending. If you're worried there's something about how the portfolio is set up, we get the same results if we instrument for the change in the security values just by the change in the treasury rate times how big your AFS portfolio is, taking the composition kind of out of it. And finally, we can also control for simultaneous cash flow and deposit channels if you're worried about something about deposit betas or something like this. The results are the same.
Okay. More 2 minutes.
Okay.
2 minutes.
Great. Yep. All right. So now we basically go to the firm level. I'm just going to set up this regression. It's going to be a firm level growth rate in various things on a firm fixed effect, a time effect, and basically the change in AFS value at that bank. Basically we're looking at how much your firm is exposed to changes in AFS value from a given bank and what that does to how much it overall is exposed to changes in AFS value to all of its lenders. And we're going to look at what it does to its outcomes. So in terms of total debt, we see that as a big effect, right? So as security values are falling, banks would be cutting their total debt. These are very similar numbers to what we saw before. It shows banks are not substituting toward other sources of credit. We have effects on investment that are large and effects on cash that are large. But again, if you break it down by whether the firm is small or large, these only come through for small firms. They don't come through for large firms. So with my last minute, let me briefly show you how we set up a model here we're going to have, based on our previous work, small constrained firms that are very bank dependent on term loans, large unconstrained firms that have access to credit lines and corporate bonds. We're going to have a banking sector with costs of basically holding or raising capital that we're going to calibrate very carefully to match our empirical regressions. And I'm going to show you an experiment where we basically have a rise in interest rates. Okay, so what do we see? On the top is our aggregate response, right? The risk-free rate goes up, security values go down. These are long-term securities. They fall a lot in value. And now what I'm going to show you is two worlds, right? One, which is the world we live in, that's the red line, compared to a counterfactual world where nothing is marked to market. In our real world, we have this big increase in required bank capital that's putting pressure on bank balance sheets, and they're going to react to that basically by cutting credit supply, raising the term loan spread. In the counterfactual world where everything's book value, you see nothing happen. So what's happening to the individual firms? Well, for the big firms, they're basically not dependent on current bank spreads. They use corporate bonds or credit lines with fixed spreads. Nothing changes about their financial position. So nothing changes between the two economies, right? And don't worry about the baseline results. I'm really interested in the difference between the red and blue lines. For the small constrained firms who have to basically absorb this spread, who are dependent on new term loans from the bank, you see that actually they have a huge decline in debt. That passes through in a big way into causing them to decrease investment, cash holdings, and dividends, right? When we aggregate over both firm types, the big firms are actually a much bigger share of real economic output, but still we see a huge decline in overall bank credit between the two economies. And we also see that in general investment is about 2 or 3 percentage points lower, and this is kind of persistent over the foreseeable horizon. So in general, this is the force that amplifies the fact that interest rates decrease investment and makes that drop in investment bigger, the difference between the blue and red lines over time. Okay, so let me wrap up here. In this paper, we use detailed data on bank securities to show that changes in security values have a big impact on bank lending to firms, but mainly when these gains and losses impact capital requirements, which is unhedged AFS and AC banks, much less when those gains and losses don't affect the regulatory channels, such as NC banks, hedged AFS, or HTM. We see that this actually passes through into firm outcomes, into their total borrowing, investment, and cash holdings only for small firms. And our model that I showed you very briefly shows that there's much stronger transmission from both real or even just nominal rates into bank lending and firm investment when banks have AFS securities marked to market. Thank you very much.
Many thanks, Daniel. So to close, to finish this session, let's have the discussion with Doriana Susinelli from University of Milano, Bicocca, Italy, and also with the help of Professor Yayadi that started the discussion at the beginning. So Doriana, the floor is yours. Thanks.
Yes, one moment. I try to. Okay. Can you see my screen?
Perfect.
Okay, thank you very much to give me the possibility to discuss this very interesting paper. A short summary to understand if I understood correctly the paper. The paper focuses on the transmission of monetary policy through bank securities portfolio, and it is focused on US banking system, and use a very granular data that refer to both bank securities and also the firm's characteristics. The paper focuses on a very short period from the beginning of 2021 up to the beginning of 2023, and the results are very interesting because the authors find several spillover effects on different kind of security characteristics. In particular, the spillover effect was stronger for available for sale securities, for unhedged securities, and for AC banks, so banks that have to include unrealized gains and losses in the regulatory capital. Finally, authors find also that there are some differences in terms of impact depending on the size of firms, and in particular, smaller firms are more impacted by the reduction of lending. I think that this last results is very interesting, and I suggest to the authors to give more emphasis to these results also in the introduction. So the paper is very interesting, and it is written very well. I think that this topic obviously is a very current topic and focus on a very recent period that considered the monetary tightening cycle in 2022. Also in terms of database, I think that the database is a very amazing database with granularity of data, because you have all the information about the securities in terms of difference between held to maturity, available for sales, the percentage of securities that are hedged or unhedged, and you have also the possibility to link the information that refer to each firm loans. So this kind of data give you the possibility to have a very interesting empirical analysis. In terms of policy implication, also in this case, the paper give a lot of policy implications, and it is very interesting to observe the effect of the monetary policy on bank lending, but through the kind of the composition of the security investments. So some suggestion. Basically, the paper is very long. The paper is about 80 pages. So basically, it seems that are two papers in one on the effect of the value of securities on bank lending, and one that is a second part, more specific with the structural model. I don't know if you can try to or split the paper, or also to give the possibility to the reader to understand better the relationship between the two parts of this paper. With regard to the aim of the paper, the aim is very clear. However, I suggested to clarify the hypothesis, for example, to include also in the literature review a section for hypothesis. And with regard to the results, the paper focus on specific monetary tightening in 2022, 2021, and on US banking system. Probably the findings may not be easily generalizable for other periods or other countries, and I suggest also to include this possible limitation in your conclusion. With regard to the data, so you focus on the period from 2021 first quarter to 2023 first quarter, and also in the robustness you consider the COVID period, so the 2020. I don't know if it is possible to use also previous data to observe the change in the interest rate, to understand, for example, the effect of the change in the monetary policies, not only the period in which the interest rate starts to increase, but to consider also the previous period. With regard to the AFS, so the available for sale securities, I don't know if you have considered the possible problem of endogeneity, because as you said in your paper, the amount of AFS securities depends on the managerial decision and the type of banks, because if a bank is a AC banks, or if the bank is an NC banks, the decision to use securities as AFS or held to maturity is different, because obviously also the gain and losses have a different impact on the regulatory capital. So I don't know if in this case the decision to use one or the other kind of security can can give some problem of endogeneity. For example, if you try to expand your time period, you can use a diff and diff method to compare, for example, the effect of the increase in interest rate on bank loans throughout the kind of securities or the type of the banks. I think that the analysis on the type of firm is very interesting, and you consider only the size. But do you think that there could be also different effects depending on other kind of firm characteristics, such as, for example, the level of default risk, the sectors, or the level of leverage at firm level? With regard to one of the tables that also you show, that is the 7.2 in the paper, where you consider the hedge and unhedged AFS securities, you find that only hedge securities have an effect. Only unhedged securities have an effect, and this is quite expected results because they are unhedged securities. But do you think that also the weight of these kind of securities can affect the results? Because, for example, the AFS hedged securities have a very low weight on the total of security portfolio, only the 11%. And finally, with regard to the bank business model, I don't know if you can also consider the bank business model, because obviously the behavior of banks may differ depending on the type of business model that they implement. I suppose that the effect could be different depending on if the bank is an investment bank or if the bank is a retail banks. And with regard to conclusion, I think that you can give more emphasis to your conclusion, because the paper have a lot of results, very interesting results, but I think that you can develop better the contribution to the literature and the policy implication in the part of the conclusion, because in the introduction, this is very clear, but yes, I think that also in the conclusion you can give more emphasis, for example, also to the channels that you discuss in the introduction, but during the paper, this emphasis is not so relevant. And finally, with regard to the monetary transmission, should be better explained, for example, giving more description of the difference between the effect on AFS and HTM securities. Thank you.
Many thanks, Doriana. Now, do we have any questions from the audience as well? I don't see any, and also from the chat we don't have for now. So maybe we can start the answering to this. Daniel, please.
Sure. Well, thank you, Doriana. That's really great discussion. We really appreciate all the comments. So, you know, I think in general, like, I'm fairly open to the idea that we could refine our empirical results in certain ways. I mean, in general, you know, some of these questions, I think, you know, some things we've gone part of the way. So in terms of doing a diff and diff, I think, like, if you like that kind of style, remember that we do have these results. Maybe we kind of throw too many out there, but we do have these results where we look at the change in AFS securities and then do interact that with being an AC bank where you're affected. And so I think those are some of our kind of stronger results, but that critique is certainly relevant for the remaining ones. And in terms of the idea that the amount of AFS you hold could be endogenous or biased, I mean, you know, it's fair. We at the moment when we're actually controlling for bank characteristics, for most of the regressions, kind of because it wouldn't totally make sense, we don't put the amount of AFS securities in because that's super correlated with the change in value. But actually, the one place we could put it in is where we're comparing AC versus non-AC banks, because ideally that could be a characteristic where the amount of AFS securities you have, that actually should, the baseline effect actually should wash out, and it really should be that kind of in some way interacted with being an AC bank that gives us our main effect. So we'll think about that for sure. But I think, in general, these are good suggestions, and we are thinking about, what's the cleanest way to get all of our results there. Are there more comprehensive ways where we could include multiple, we're at the moment, we're kind of doing these things in parallel with the hedge, as you pointed out, and the AC and the AFS, HTM thing. Is there a way to get all of that into one regression where it would be even cleaner? We're kind of playing around with these things. So the points are definitely well taken. And I think your other suggestions in terms of, highlighting different things in the paper all seem quite reasonable. So because if there's no questions, I'm sorry to, I wish I had a lot of, aggressive things to say so we could fill the time. But no, I think it's very well taken, and we appreciate it.